Assalamualaikum. So today our group is presenting about business finance, which is financial ratio. Ratio is the relationship between two or more financial statement components and determined using ratio. They are especially effective when comparing outcomes over multiple time periods. They are one tools that may be utilized to undertake financial analysis on the history, industry, or business sector of the economy. There are five types of financial ratio that you guys should know. Well, the first one is liquidity ratio, which this measurement assess a company's ability to repay both short and long-term debt. And second is asset management ratio. We use to assess the how well a company use its assets and resources. Next is debt, as you can know. Debt management ratio, which is the determine the amount of capital derived from debt. To put it in another way, that ratio are used to assess a company debt level. And the fourth one is profitability ratio. That you can see there is measure a company ability to make profit in terms of revenue, asset on the balance sheet, and operational cost and equity. And the last one is marketability ratio, which is used to assess the share price of commodity stocks. Next, we move to the first one, liquidity ratio. For the liquidity ratio that we use from the our assignment that cause the result, which is the liquidity has two, which is current ratio and quick ratio. Quick ratio uh, is the current asset minus prepaid expenses and minus inventories divided by current liability, which is we got the 1.8 times. For the current ratio is current asset divided current liability, which is we got for the result is 2 times compared to the industry. Next, I move to the other group.
Thank you, Hidayu. My name is Nabil Safwan. I'm going to talk about asset management ratio, which has four types. The first is inventory turnover ratio. The second is average collection period. The third is non-current assets turnover ratio. And lastly, total asset turnover. Now I'm going to talk the first two, which is inventory turnover ratio and average collection period. Inventory turnover ratio, which we take from sales, we divide inventory. For example, 17 million divided by 1,310 equal to 12.98 times. The average collection period, which we take from account receivable, which is 1.7 million divided by credit score 15.3 million divided by 360 days. First, then we divide with credit score with 360 equal to 42,500. Then we divide with 1.7 million equal to 40 days. Now we can talk about non-current asset turnover ratio, which we take from sales, 17 million divided with non-current assets, which is 6,800,000. Equal to 2.5 times. And lastly, total asset turnover, which we take from sales, that is 17 million, divided with total asset 11.2 million, equal to 1.52 times. Now I'm going to talk about debt management ratio, which have three debt. The first is debt ratio, the second is debt to equity, and lastly, time interest earned. I want to talk about the two first, which is debt ratio and debt to equity. Debt ratio we take from total debt divide total asset. The total debt is 3.4 million divided with total assets, which is 11.2 million, equal to 30.36%. While debt to equity we take from total debt divide with total equity. Total debt is 3.4 million divided with total equity, which is 5.8 million, equal to 58%. And lastly, time interest earned, which is EBIT divided interest expense. Debit is 2.4 million divided with interest expense, which is 360,000, equal to 6.67 times. And that's all for me. Thank you very much. Now, now we'll continue for the next part.
Okay, for profitability ratio, there's gross profit margin, which is gross profit or sale. For the amount is 7,200,000 divided by 17 million equals to 42%, 42.35%. As for operating gross profit, uh, EBIT or sales divided by sales, which is 2,400,000 divided by 17 million equals to 14.12%. For the net profit margin is net profit divided by sales, which is 1,530,000 divided by 17 million equals to 9%. As for return on asset, the formula is net income divide total asset, which is 1,530,000 divided by 11,200,000. That's equal to 13.66%. The next profitability ratio is return on equity. The formula is net income divide common equity. The amount is for net income is 1,530,000 and for common equity is 5,800,000, which will be equals to 26%. For marketability ratio, there will be three ratio. For the first ratio is earning per share. The formula is net income divided by number ordinary share, which concludes to 1,530,000 divided by 4 million equals to RM 0.38 cents. For dividend per share is dividend divided by number of ordinary share, which conclude for dividend is 600,000 divided by 4 million, which equals to 0.15 cents ringgit Malaysia. As for the last marketability ratio is dividend payout ratio, which is dividend per share divided by earn per share, which is 0.15 cents divided by 0.38 cents, which equals to 39.47%. We continue for the comparison. As for liquidity ratio, there is current ratio and quick ratio. For current ratio, Hikmah Bati Berhad is 2 times, while the industry has 2.1 times. The current ratio of Hikmah Bati Berhad in 2021 is lower than the industry average. This shows that the company will have a problem paying the money in time. As for quick ratio, Hikmah Bati Berhad is 1.8 times, while the industry has 0.9 times. Hikmah Bati Berhad has higher liquidity assets than the industry. As for the next comparison is asset management ratio. The first ratio is inventory turnover ratio. For Hikmah Bati Berhad, inventory turnover ratio is 12.98 times, while the industry has 6.5 times. Based on the inventory turnover ratio in 2021, it suggests that the firm has a solid financial performance. The next ratio is average collection period. For Hikmah Bati Berhad, the average collection period is 40 days, while the industry has 35 days. The average collection period of Hikmah Bati Berhad is higher than industry average. Based on the average collection period in 2021, it suggests that the firm had a solid financial performance. Continuing to the next slide, which is the comparison for asset management ratio. The third ratio is non-current asset turnover ratio. For Hikmah Bati Berhad, the non-current asset turnover ratio is 2.5 times, while the industry has 2.0 times. The non-current asset turnover of Hikmah Bati Berhad is higher than the industry average ratio. Based on the non-current asset turnover in 2021, it suggests that the firm has a solid financial performance. For the last ratio is total asset turnover ratio. For Hikmah Bati Berhad, the total asset turnover ratio is 1.52 times, while the industry has 1.6 times. The total asset turnover of Hikmah Bati Berhad is lower than the industry average. Based on the total asset turnover in 2021, it suggests that the firm has not had a solid financial performance.
And thank you, Hadif. Next, we talk about management ratio, which has three: debt ratio, debt equity ratio, and time interest earned. Now we talk about debt ratio for Hikmah Bati Berhad. The debt ratio is 30.36%, while the industry has 40%. The debt ratio of Hikmah Bati Berhad is higher than the industry. Based on the debt ratio in 2021 against the industry average, it suggests that the firm has a solid financial performance. Now we're going to talk about debt equity ratio. For Hikmah Bati Berhad, the debt equity ratio is 58%, while the industry has 60%. The debt equity ratio of Hikmah Bati Berhad in 2021 is higher than the industry. Based on the debt equity ratio in 2021 against the industry average, it suggests that the firm has a solid financial performance. And lastly, I'm going to talk about time interest earned. The ability of Hikmah Bati Berhad to cover the interest is 6.67 times, while the industry has 7 times. The times interest earned by Hikmah Bati Berhad is higher than the industry based on the time interest earned in 2021 against the industry average. It suggests that the firm has a solid financial performance. And that's all for me. Now we continue for the next person.
So now we're going to talk about comparison profitability ratio. So the first one, gross profit margin. The ability of Hikmah Bati Berhad shows that the gross profit margin is 42.66%, while the industry is 38%. The ratio of Hikmah Bati Berhad shows the efficiency controlling the cost of goods compared to the industry average. The higher the ratio, the better the outcome. So the next one, operating profit margin. The ability of Hikmah Bati Berhad shows that the operating profit margin is 14.12%, while the industry is 18%. It shows that the industry operating profit margin is higher than Hikmah Bati Berhad's. So next, net profit margin. The ability of Hikmah Bati Berhad shows that the operating profit margin is 14.12%, while the industry is 18%. It shows that the industry operating profit margin is higher than Hikmah Bati Berhad. Now we're going to talk about the return on equity. The return on equity for the ability of Hikmah Bati Berhad shows that the return of equity is 26%, while the industry is 20%. So the higher the return on equity, the better the return for the company shareholders. So last but not least, operating profit margin. The ability of Hikmah Bati Berhad shows that the return of asset is 13.66%, while the industry is 12%. It shows that the company is able to make profit from the company investment. So next, comparison marketability ratio. So the first one, earning per share, and the second one, dividend per share, and third one, dividend payout ratio. We're gonna go for the earning per share first. So the ability of Hikmah Bati Berhad shows that the earning per share is RM 0.38 ringgit Malaysia, while the industry is 0.28 ringgit Malaysia. It shows Hikmah Bati Berhad can make higher earning per share than the industry. For the second one, dividend per share for Hikmah Bati Berhad, the dividend of per share is 0.15 ringgit Malaysia, while the industry is 0.14 ringgit Malaysia. Hikmah Bati Berhad can profit from dividends for the ordinary shareholder rather than the industry. So the third one, dividend payout ratio. For Hikmah Bati Berhad, the dividend payout ratio is 39%, while the industry is 30%. Hikmah Bati Berhad has higher net income that relate to dividend shareholders to pay out their return than the industry. Now we're going to talk about the limitation of financial ratio. The ratio analysis method is a powerful instrument for assessing a company's financial health. It does, however, have important limitations that should be considered before embarking over an investigation. The difficulty of comparability is inherent in ratios. If they are generally identical, they may use different accounting procedures, which can make it difficult to compare certain essential relationships. The usefulness of accounting ratio may be affected by inflation. Historical cost-based financial statements and accounting data do not reflect current value figures due to inflation, especially when assets are purchased at different times by different firms. The information report by the company is financial account is used to do ratio analysis. This data could be modified by the company's management to show a greater performance than it actually has. As a result, ratio analysis may not adequately reflect the underlying nature of the firms because information misrepresentations is not detectable by basic analysis. So, the conclusion is we can finally comprehend the position in the organization based on the assignment that we discussed as a team of financial officer from Al Raji Bank. Based on the financial ratio we calculate, we determine that Hikmah Bati Berhad is eligible to apply for a business loan. We can see that Hikmah Bati Berhad's ratio outperformed the industry average. The three reasons we approved the application were because the profitability ratio showed a positive outcome from which income was generated. The activity of Hikmah Bati Berhad, which used less debt. Next, finally, Hikmah Bati Berhad's marketability ratios show a positive association between the firm's share price and dividend and earning. I guess that's all from us. Thank you so much for listening. I hope you enjoy the video. Thank you so much and have a nice day. Bye bye.